Hello everyone. Today I'm going to share you my project, the bank loan case study. I worked on a real world banking data using Excel, and this project covered everything from missing value treatment to correlation analysis. Let's break it down step by step. As a data analyst at a finance company that provides a various type of loans to urban customer, one of the key challenges we face is applicant who are likely to default on their loans, especially those with a limited or no credit history. These cases often leads to a financial losses when high risk applicants are mistakenly approved. When a customer applies for a loan, the company faces two major risks. If a capable applicant is rejected, we may lose a potential business. If a high risk applicant is approved and defaults, it results in a financial loss. To address this, I am performing a EDA on a dataset containing information about the loan applicants. The dataset includes two categories: customer with the payment difficulties, customer who made at least one of the late payments in the first year installment, or other cases customer who paid on a time. The aim of this project is to analyze how customer and the loan attributes influence the risk of a default. Through EDA, I am identifying trends and patterns that indicate whether a customer may be struggle with repayments, business objectives. Detect a key indicator of a loan default based on an applicant's characteristics. Support a smarter approval decision by identifying a risky profile early. Reduce the financial losses and improve the overall lending strategy. This analysis helps the company make a better decision, such as denying a high risk loans uh, to reduce or increase the loan amounts, offering a higher interest rates to risky customers. It also ensures that capable applicants are not mistakenly rejected, which help grow the business without increasing a default risk. My first task was to identify null values, handling missing data. So for this, I have used count blank function to count a total number of blank rows in each column. After that, I have found the percentage of null values in each columns using a formula. Total number of blank rows upon total row counts. After that, I have removed all the columns having a null values present more than 33%. For a column having a less than 33% null values, I have done mean median mode for a missing values. So I have removed more than 50 number of columns in a data set. Initially, the number of column was 122. So most of columns, those I have removed, where have thousands of null values in present. The second task was to find the outliers. Outliers can seriously distort any data analysis and leads to misleading averages, skewed visualizations, and the inaccurate models. That's why identifying and handling them properly is important in any data project. To detect outliers in this project, I used the IQR method. Using a Excel quartile.inc function, I calculated Q1. Q1 is a 1/4 of percentile. Q3 is a 3 by 4 percentile, and then IQR. IQR is a Q3 minus Q1. I set I set the outlier boundaries as lower limit and upper limit. Lower limit is Q1 minus 1.5 times IQR. Upper limit Q3 plus 1.5 times IQR. This approach helped me flag extreme values in critical columns such as amount credit, CNT children, amount annuity, working days, date of births. These outliers were then highlighted using a conditional formatting in Excel. Why does this matter? Because outlier can artificially inflate or deflate summary of data, misguide business decisions if left untreated, cause the predictive models to behave unpredictably. In short, handling an outlier helps ensure that our insights are trustworthy, stable, and closer to reality. Next, I analyze the data imbalance in the loan default target variable using a data imbalance sheet. Out of a total application, 92% of applicants were paying their installment on time, labeled as 0. 8% had a payment difficulties, labeled as 1. That give us a class imbalance ratio 11.3, meaning every one defaulter there were 11 applicants who paid on time. Why this is so important? In a predictive modeling, especially in a binary classification problem such as imbalanced data set, can lead to models that are biased towards the majority classes. Without proper handling like resampling or using a class weights, the model might fail to correctly identify potential defaulters. To visualize this, I created a bar chart and pie chart clearly showing a skewed distributions. Then I have done some other columns like male female ratio. In data imbalance, 34% male and 66% female they were present. Now let's dive into a univariate analysis where we analyze one variable at a time to understand its distribution and identify pattern in the data. The bar chart shows how long applicants have been employed. The majority of applicants have 0 to 5 years of working experience, which could be a first time borrower or these early in their careers. There is also a spike in the 50 years category, possibly due to data anomalies or long form employment histories. Education level, when it comes to education, around 71% of applicants fall under a secondary and secondary special category. Higher education applicants make up about 25%, while a advanced degree like academic degrees are extremely rare. Why it's matter? Education level often influence income potential and financial literacy both, which impact the repayment of capability. Housing type, housing status reveals that over 89% of applicants live in a house or apartment. This indicates a sense of residential stability, which could influence a loan approval decisions. Gender, the gender distribution shows that 66% of applicants are female, while 34 are male. This helps us understand the demographic dominance in loan applicants. Income level, applicants' income are heavily clustered between 85,000 to 1 lakh 75. The peak is at 85 to 115 range with over 10,000 applicants, showing a concentration of a middle income borrowers. Loan risk and approvals depend upon heavily on an income bracket, and this distribution highlights the core economic segment being served. Loan contract time. Lastly, let look at loan types. About 91% of loans are cash loans and 9% are resolving loans like credit cards. This tells us that the most applicants are taking a one-time loan likely for a purchase or expense rather than credit lines. Univariate analysis helps us understand the shape and spread of individual variables. These insights are crucial for identifying trends and planning risk in a loan approval processes. Here is a segmented univariate analysis of a loan default dataset. Housing versus target default. Housing apartment is the most common housing type but also continues significantly to defaults. Rented apartment and municipal apartments have proportionally higher share of defaulters. Cooperative apartments, office apartments, and living with a parent shows lower default rates, possibly indicating a financial stability or shared liabilities. Rented and municipal housing may indicate a financial vulnerabilities worth closer scrutiny in a risk modeling. Credit amount versus target. Higher default occur in a lower credit range of 4 lakh 50,000 to 7 lakh 95,000, mainly due to higher volume. Default declines as a credit amount increases, although sample size also decrease in a higher ranges. Default risk is a concentrated in a mid to lower credit bands. High credit customers might be screened more stringently or financially stronger. Marital status is target. Married individuals form the largest group and have a highest count of default by volume. Separated and single, not married groups have a proportionally higher default rates. Marital instability may correlate with a higher credit risk. Contract type, which is target. Cash loan dominates in dataset that and the default also. Revolving loans have a smaller population but a slightly higher proportional default rates. A revolving loan could be pose a higher risk as per customer, though they are fewer in numbers. Working year versus target. Default rates are higher in 0 to 5 years of employment, indicating instability or early career risk. Risk steadily reduced with experience, especially beyond 10 years. Very long tenure have a very low default rates. Employment duration is a strong indicator. Fewer working years mean higher default risk. Majority of a defaulter are from a secondary education background. Higher education and academic degrees shows lower default ratios. Higher education may indicate financial awareness or better income opportunities, reducing default risk. Gender versus target. Female form a larger group and have slightly lower proportion default rates than male. Gender based segmentation shows minimal but notable variation in default behavior. Men might need a slightly more cautious risk profile. Income basis target. High default volume are in a middle income groups. As the income level increases beyond 2.65 thousand, the number of default rate drastically drops. Mid income segmentation require a closer attention. Very low and very high income groups shows fewer defaults. Shorter employment, mid to low income, lower education, and rented municipal housing are key red flags. Contract and marital status also contribute to differential risks. These insights can feed into a features engineering or a risk scoring models. Let's dive into a bivariate analysis, a powerful tool in understanding relationship between our data. Bivariate analysis refers to the analysis of a data that contains only two variables. The goal here is to explore cause and relationship. Essentially, now one variable might influence other or to be related to another. Does a higher income lead to a larger loan approval or does gender impact loan default rates? Amount income total versus amount credit. The graph you see here is a great example of a bivariate analysis. It shows the relationship between amount total income and amount credit, as is evident applicants with a higher income were typically offered higher loan amounts. This indicates directionally a proportional relationship. As one increases, the other tend to increase too. This is a key insight for designing a credit approval system. Loan type versus income, cash versus revolving loans. Here we can compare a contract type cash loans versus revolving loans against different income types. Cash loans are more common across all income groups, but what stand out in the most default happens within a middle income segments. Gender versus income. When a gender is brought into the picture, we see that female applicants dominate the middle income ranges, and this group also reflects significant proportion of our defaults. This insight can help refine a risk assessment models based on a demographic behaviors. Education level versus income level. Lastly, let's look into at a education level. The majority of applicants with only secondary or higher secondary education are concentrated in the 85,000 to 1,45,000 income range, and these groups also contributes heavily to defaults. So, education types paired with an income level becomes another critical indicator in a loan performance analysis. To sum up it, a bivariate analysis plays a vital role in a credit risk analytics by revealing how two variables interact in the bank and financial system to design a more accurate and fair credit models. To dive deeper, we created a correlation matrix. This helps us to understand how strongly numerical variables are related to one another. A strong positive correlation. Amount credit, amount annuity, and amount goods price are highly correlated, indicating that as a credit increases, the associated annuity and the good price typically go up to. CNT children and CNT fam members shows a very strong correlation, nearly about 0.89, which makes sense. More children usually means a larger family size. Strong negative correlations, days birth means age, and the days employed are highly negatively correlated with many variables. As the age increases, loan amount or income shows limited growth. Reason rating light is a negatively correlated with several features, possibly suggesting that applicant from a higher rated regions differ in financial behavior. Understanding these relationship is a critical, especially when selecting features for a machine learning models. With these EDA steps, we can build a solid foundation for understanding loan application and identifying patterns in defaults. This project helps in handling a large data set. How EDA can be applied to a large data set. When dealing with a large data set, it is also important to select only those columns which are extremely useful to our analysis. Finding a correlations column can be become very convenient while dealing with a large data set, as it saves time selecting which columns should be considered for analysis. This project can also help in understanding the various terminologies used in the banking domain. The insight drawn from projects are follows. Applicants drawing higher income were offered higher loan amount by bank. Majority of applicants drawn an income range between 1.25 lakh to 1.5 lakh. Also defaults drawn income between same ranges.